Hi, everyone. My name is Rachel Brenden. I am a senior tax accountant here at Duncan Aviation. I've been with my position for about a year now. Before I came to Duncan, I was in public accounting doing taxes for individuals and corporations. So that's a little bit about my background. This session today is going to be recorded and they will put it up on YouTube by the end of the week. So feel free, if you don't want to be on the recording, go ahead and shut your camera off if you would like. Today we're going to talk about a few things regarding HSAs, FSAs, kind of what they're about, how to best utilize them, and then I've just got a quick few tax updates for 2025 and 2026 just to kind of give you guys an FYI. Before we get into the material, I did want to kind of gauge you guys and see where you're at, what you want to learn about today, and we can kind of tailor it from there. So this is a Mentimeter. It's kind of like Kahoot if you've done that in any of your trainings. If I could have you guys scan the QR code at the bottom with your phone. Otherwise, you can go to menti.com at the top and then type in that code, and it'll bring you up to this survey here. And everything you post on this is totally anonymous, so don't feel like your name's going to be associated with it or anything. Give it just another minute for people to join on here. Okay, let's go ahead and go to the first question. What's your financial goal for 2026? Whether that's budgeting, feeling like you're getting your finances organized. I want to contribute more into my retirement or my HSA. I want to pay down debt, anything like that. Okay, perfect. It looks like paying down debt, budgeting, and increasing savings are probably the top out of this group here. I'm going to go ahead and flip to the next one. How confident are you in your knowledge in personal finance, whether that's a spectrum from not confident at all to you're super confident or you're kind of in the middle and you're not quite sure. Yeah, it looks like we're kind of in the middle ground. So that's good to know. And then the last thing I kind of just wanted to share off and start this presentation with, these are kind of personal finance and tax topics. Everyone's situation's unique, right? Some have kids, some have a spouse, some are single, fresh out of college, some are getting close to retirement. And so everyone's situation is, it depends on what other factors you have going on in your life. I'm going to kind of present this information from kind of a thousand um, feet view and kind of give you the raw information as a whole. And then if you have any specific questions, definitely type them into the chat. I'll kind of pause after each topic and we can take questions at the end of each topic and then at the very end as well. So like I said, we're going to talk about HSA, FSA, and then a couple updates for taxes this year. So health savings accounts, that's what HSA stands for. You are eligible to enroll in this whenever you are enrolled in a health insurance program that has a high deductible, which is what Duncan, that's the only kind of health plan that Duncan offers. You can also get into this if you're not on Duncan's health plan, but maybe your spouse has a high deductible health insurance plan through their work. And it's basically to help create a savings platform to help bridge the gap so you can afford those medical expenses up to your deductible. And these are really great savings tools. It's kind of a triple savings strat is how I like to explain it. And so all of the money that you put into your HSA account, you're not taxed on that. And then within your HSA account, you can do investments, and then anything that grows in your HSA account that grows tax free. So you're not paying any taxes on the income that you're making in the account. And then when you go to spend your HSA funds, whether it's this year or in the future, as long as it's for a qualified medical expense, which is quite a few things, and we can talk about those here in a little bit, that's also tax free. Now, there's a couple nuances with that. If you do decide to spend your HSA funds on something that's not qualified medical expenses, let's just say you accidentally think it's your debit card and you go on a shopping spree for the weekend, you will get taxed on that, whatever you spend. And then if you're under 65, you'll also get a 20% penalty when you go to file your tax return. So you just want to make sure that you're spending that on those qualified medical expenses. And they don't have to be current expenses by any means. If you really want to use this as an investment platform, you have the means to do it right now, you can pay for your medical expenses up front, keep those funds in your HSA account, let it grow, and then when you want to empty out that HSA account or start getting reimbursed from it, you can reimburse those receipts from, 5, 10, 15 years ago and get the funds out at a higher rate since they've had that time to grow. And then as far as contributions, these limits are for what you put in and then what Duncan puts in as well. So that's just one thing to keep in mind, as profit sharing comes out, those quarterly bonuses, the team member choice program, anything like that. So if you're single, the contribution for this year is 4,400. That's between what Duncan puts in and you put in. If you're in a family plan, you can put up to 8,750. And then if you're 55 and older, you get to put in an additional $1,000. And then next, I just wanted to talk about kind of investing in your HSA and how the platform works itself. And so all of our HSA accounts are through Optum Financial. If you're not set up through that website, you can go to the common benefits, the helpful benefit links spreadsheet that HR has out there. And they've got a website and a phone number. They also have an app that's really helpful that you can manage everything through there. So you can see, what you've contributed, what expenses you've either spent on your card or reimbursed yourself for, and then what's your current balance. And then through this website, they also have links on where you can invest your money in your HSA for. There's three different platforms. There's Betterment, and then mutual funds, and then there's a Charles Schwab brokerage account. I kind of like to explain these in different ways on how comfortable you're with your personal finances and your investing. So Betterment, that's the one I personally use just because it's nice and easy. They basically ask you like 4 or 5 questions saying, how risky do you want to be? Um, what do you like for a mix between stock and bonds? And then it basically picks your investments for you. If you're not super familiar with financial terms, stocks are, you go buy a part of Apple and in return you hope to get dividends back, either quarterly or monthly. And then you also get income on whatever the stock appreciates. So if it increases in value, you're also making more money because then eventually you could sell it at that higher price. Now, stocks are a little bit riskier, and it depends on, what kind of stocks it does, but that's kind of why they ask those risk portfolio questions. That way they can get you a good blend of, where you're comfortable at. And depending on your different life situation, you could be more risky or you could be more conservative. And then bonds, think of that as like you're basically loaning a company money and you're getting interest payments back, on a regular interval. So those are a little bit more stable. If you choose not to invest in your HSA account, they basically put your money in a savings account, 2, 3% maybe. It's keeping up with inflation. That's about it. So you're, it kind of looks like you're making money, but when you think of inflation, you're not really making any money at all. The mutual fund platform, if you do some other outside investing, you have a really good mutual fund that you like to use, like a Vanguard mutual fund or something, that's where you can go and put all your money into this mutual fund. And a mutual fund is just a pre-made mix of stocks and bonds and other securities. And then the Charles Schwab brokerage, that is fully where you would manage it yourself. So I would say if you're very, very confident in how you like to manage your investments and you like to be super hand-on, go for that Charles Schwab. If you're, a little bit of a newbie or you want a hands-off approach, maybe that Betterment is a better platform, and then mutual funds is kind of, somewhere in the middle. One thing I wanted to show you guys just to give you a little bit more perspective on, what your HSA could do for you. So I put in a scenario here, and this is just using Duncan's money. This is not what you put in, if you're really focused on debt reduction or, saving for your first house or paying off your mortgage. This is just a scenario of what Duncan puts in. And let's just say, about a fourth of that you spend in actual medical expenses a year. Now, I kind of use my time scenario since I'm newer at Duncan here. I put in 20 years. You can also look up this calculator if you want a rough number too, if you want to figure out, how much you want to put in. I just Googled HSA calculator and put all this stuff in here. So this is a scenario of where you just use Duncan's money, you spend about a fourth of it, and you just let it sit there. So at the end of 20 years, when I'm ready to retire or getting close to retiring, I'll have about 40,000 in there. Now, if I were to take that and to invest in just, kind of middle ground risky investment, a market, 10%, 8, 9, it's 83,000 there. I just doubled my money just by picking an investment platform. So that's an extra $40,000 that's grown in there tax free. You can pull it out for medical expenses, anything like that. So I just wanted to show you guys kind of the impact of, you don't even have to put any of this money in. This is just what Duncan provides for you guys. And you can run different scenarios for yourself too. If you end up meeting your deductible a lot, you can up that even if, to 1,000 or 1,500 and kind of look at where you're at with your own personal situation. A couple other things in the Optum app that I learned from the presentation on Friday. If you ever have any questions about what's reimbursable or what qualifies as a qualified medical expense, Optum has the app where you can scan the barcode, like if you're at CVS or Walgreens or somewhere else, and it'll tell you if it's HSA qualified. I know sometimes on Amazon they'll just have a little bottom note that'll say HSA, FSA qualified. But I like to think of, regular medical expenses like doctor's bills, physical therapy, anything like that. And then honestly, it's a lot of stuff that you get at the pharmacy, vitamins, cold medicine, eye drops, canes, walkers, anything like that. So, I'm going to go ahead and pause there. Does anyone have any HSA questions, that they want to go over right now?
We did have a question come in. Rachel, can you hear me okay?
Yep.
If your HSA funds outlive you, do heirs have to pay taxes on it when they inherit it?
Yeah, that's a good question. So when you have a parent or someone dies like that, you can use whatever remaining balance is in their HSA to pay for those final medical expenses. And then anything else will be taxed just as at a regular rate. It won't be subject to that extra 20% penalty or anything. But like I said, a lot of these expenses qualify, especially if your folks or older, a lot of nursing home expenses, and then any of those last final hospital bills after, you get after they pass away, those qualify too. So I haven't seen very many scenarios where people have a lot of HSA balances after they pass away because, you can rack up a $3,000 or $4,000 bill at the hospital pretty quick. Any other HSA questions?
A couple of them are coming through right now.
Okay.
And I did see that somebody had a hand raised. If you did have your hand raised, it looks like it disappeared. But if you could type that into the chat, that would probably be the easiest format for this.
I
So,
took it back down because she answered the question. Thank you.
oh, thanks, Chris. Okay, so another question, Rachel, was when we retire, do we have a specific time frame we have to use and close the HSA?
No, when you retire, and that's kind of one big thing between an FSA and an HSA. HSA you keep until you pass away. An FSA account you have to use before you finish and retire up. So that's a nice thing too. You cannot contribute to an HSA unless you're enrolled in a high deductible health plan. So once you retire, you can't continue to contribute, but you can let that sit in there and grow tax-free while you're in retirement.
Awesome. Somebody else asked, we've got 2 or 3 more questions / comments. Are dental copays covered under HSA purchases?
Yes, I believe so. I know I've used mine at the eye doctor before, so I would think that dental copays would work as well.
Okay. And then somebody asked, they said that they've had their HSA card denied when purchasing items like aspirin at Walmart, and why would that possibly be the case?
Every retailer is a little bit different. Sometimes I've had mine denied if I have non-HSA qualifying items in the same cart. So, one thing to try is maybe, have a separate order and have them ring it up separate. Otherwise, you can always just keep that receipt and reimburse it through the Optum Financial website too.
Good to know. And then Mary Koning, our benefits generalist from Battle Creek, also chimed in and just said, don't forget to put beneficiaries in Optum Financial.
Yes.
So that's just a reminder for everybody. That's all I've got on the chat
Okay.
side.
Perfect. Anything else that's not in the chat? Anyone else want to ask a question before we move on?
Oh, we just had one more, sorry.
Okay.
Somebody said they did not continue their medical plan with Duncan this year, and they're asking if their current HSA balance stays with them forever until used or withdrawn. And then they said most of it is wrapped up in Betterment. Does that matter?
No, it doesn't matter. You can keep it in Betterment, or if you go to a different job or your spouse does, you can always roll over those HSA funds to a different platform. That's what I did when I came to Duncan. I had an HSA at my old employer, and you can just call them and ask them to roll it over. That way it's all in one platform. And you don't have to worry about 5 different logins and 5 different accounts. But yeah, as long as you're kind of similar to when you're retired, you can just keep that money in there and it'll just keep growing.
Okay. 2 more questions for you, Rachel. Is that okay?
Yep.
Okay. Somebody asked, they said that their daughter is not covered under her insurance here at Duncan. Can they still use the HSA?
It gets a little dicey with that. I would say if you have a family plan, you could maybe push the button a little bit, but really the big risk is that all of this gets reported on your tax return on what expenses you pay and what you contribute. So it's whether or not you're personally really willing to take that risk on the IRS looking at it, and disqualifying it. As a CPA, I'm going to say no, but as a human being, I'm going to say push what you want. So,
All right. The other thing, Mary Koenig said she's going to handle. So, Michael, I hope you get the
okay,
answer you're looking for. And otherwise, I think we are good to move on.
perfect. Okay, so then another option within Duncan's benefits is a flexible spending account. This is it if you're not enrolled in our high deductible plan. If you're on your spouse's health insurance, this is a good option to put aside some money for either medical care or dependent care.
Yeah. So this one's the new one.
There's a couple different nuances with it. With the medical FSA, it's pretty similar to an HSA, except you have to use those funds by the time you retire, and you can only carry over $500 to the next year. So it's basically contribute what you think you're going to spend for the year. And the contributions are a lot lower, $3,400 per year. And then I know they're a little bit more stringent on what qualifies as a medical expense. And then another account is the dependent care FSA. I'm going to put a high warning on this one. Unless you're a super high earner, like your family makes over 400,000, this is going to limit your dependent care credit that you get on your tax return for your daycare expenses that you get to pay throughout the year. You can contribute up to 7,500 per family per year. And that's just an easy way to set aside funds for daycare. But again, unless you're a really high earner, I would just stay away from this because most of the time a tax credit is way better than a tax deduction like the FSA. Okay, next we're going to talk about just a couple kind of general tax overview concepts and then a couple updates for this year. So when I talk about taxes, I like to talk about how the tax system works because I think there's a lot of misconceptions out there. With your taxes, I know a lot of people think that, oh, I got a raise, but I don't really want it because it puts me in the next tax bracket and maybe I'll get taxed at 35% instead of 30%. Well, that's not really how the system works. It's a marginal tax rate. So if you can look at this chart here on the side, this is kind of how it works. So, the first 11,000 of your income, that's taxed at 10%. And then anything between 47 and 11,000, that's taxed at 12%. So it's kind of like a stepping stairs instead of just like an all or nothing approach. And so, if it puts you over the next tax bracket by 10,000, only that $10,000 of extra income is going to get taxed at the higher rate, not all of it. And then I know it's turning up into tax time here pretty soon. a lot of people, will think, oh, yes, I just got a $5,000 tax refund. That's the best thing ever. No, not really, because you just gave the government $5,000 free and you didn't make any money on that um, $5,000 when you could have put it at least in a savings account or something and made a little bit of money on it. So really your tax goal come April 15th should be, I don't owe the government anything and they don't owe me anything. So a couple new things that I want to talk about for 2025. The first thing is no tax on overtime. I know this has been big in the press and has gotten everyone super excited. What I wanted to talk about, there's, I think, some misconceptions around it. So, um, payroll will be handing out a form on how to calculate this. Unfortunately, with the IRS budget cuts and everything, they don't have enough staff to update the W-2 for this year. So it'll be more of like a supplemental statement that you can use on how to calculate it yourself, or you can just give it to your tax preparer. But with the no tax on overtime, overtime pay is usually time and a half pay. You're really only not getting taxed on the half pay that's over your regular pay. And it's not, so how it works is that you get federal tax withheld on the front end, every pay stub that you have overtime. And then on your tax return, you get to claim that half percentage or that half that's over your regular time on your tax return as a deduction. And then so that's kind of how you get your money back, and that's how that works. And so I think a lot of people thought that you were getting, the whole time and a half back, but really it's just that half back. Or if you're getting paid double time, it's just, your base rate instead of, double your rate. And then next, the child tax credit, that's increasing a little bit per child. The nice thing about it is that it's actually the refundable portion is increasing quite a bit. So if you've got no tax liability, you can still get money back from the government no matter what. And then the next update that I think is kind of a cool thing is these Trump savings accounts. So this is only eligible for kids that are born between 2025 and 2028. And it's basically a savings account that turns into a retirement account. But they can also use it for education expenses when they turn 18. So all you have to do is file an election with your tax return, or tell your tax preparer that you had a baby this year. And then the government will automatically deposit $1,000 into this savings account for you. And they'll put it into investments, and it can grow to 5,000 or 6,000 by the time they turn 18. And then you can also contribute $5,000 into these savings accounts every year as well per kid. And like I said, it can get converted to a retirement account, so they've got an early setup on retirement, or they can use it for education expenses too once they turn 18. The next thing is interest expense on certain loan vehicles. You can deduct up to $10,000 of vehicle loan interest on your tax return for 2025 as long as it's American assembled, and you can figure that out with your VIN number too, or share, if you had any new vehicle purchases, share that with your tax preparer, but it has to be a brand new vehicle. It can't be a second used vehicle. And then the next big item that'll probably impact quite a few is the state and local tax threshold is increasing quite a bit. When Trump first got into office, his tax legislation way back in 2018 limited real estate tax and state and local income tax to $10,000. So a lot of people started using the standard deduction. If you remember way back then, now it's increased up to 40,000. So you can split that between, your property tax and your state and local income tax. So you might see yourself itemizing a little bit more this year. Especially if you've got, a lot of mortgage interest or medical expenses, that kind of thing. And then these next two are new items that are starting in 2026. Charitable deductions are changing a little bit. If you remember back in COVID, you could deduct without itemizing a few $100s of charitable deductions. They are bringing that back for 2026. I think it's for a married couple, you can deduct up to $2,000 for charitable deductions if you're not itemizing. If you do end up itemizing that number, your charitable deductions will get limited a little bit. They're putting a 0.5% floor of your income. So it's basically saying like, hey, 0.5% of all your earnings for the year, we just expect you to donate that to charity and we're going to limit it. And then everything else you get a deduction for. So there's a kind of a couple ways that you can get around that. You can kind of gauge if, you're going to itemize or take the standard deduction to get the full benefit, or if you are soon to retire, and you still want to give to charity and get the full benefit, you can do what's called a qualified charitable deduction or distribution. And you just have to let your retirement plan know that you want to do it. And they basically send the donation straight from your retirement account to a local charity. And then that just automatically gets excluded from your income. And you can do up to 100,000 per year for that. And then the last one is retirement catch-up contributions. These catch-up contributions, I believe if you're over 50 or 55, you get to contribute additional funds into your 401k. One change that's starting in 2026 is that those catch-up contributions have to be post-tax contributions. So post-tax is Roth contributions. So you'll have to make that change in your retirement plan once you get to that. But they did increase the limit a little bit too. So I think for 2026, if you're over 60, it's an additional almost 4,500. So that's a little bit good of a benefit, but just a little nuance that those have to be post-tax catch-up contributions. Your regular contributions can be traditional 401k, but then anything of that catch-up piece has to be post-tax. Okay, and then the last thing I wanted to touch on is, April 15th comes, you owe the government a huge check or they owe you a big check. What do you want to do? That way we get the best use of our money today. There's a couple different ways to do this. My favorite way personally is to use this IRS tax estimator. And honestly, you can just Google it. And they've got it on the IRS website. You basically put in your pay stub information. And then, if you've got other investment income or anything like that, you can put that in there. It'll show you what your W-4 is supposed to look like. And then you can go into ADP and edit that. And it will update on your next payroll statement that, additional withholding or less withholding if you're flipping that way too. Another way is you can just set up this year's withholding to be 110% of last year's to avoid any underpayment penalty. Again, that's kind of for the super confident people and know what they're doing. And then, like I said, you make those W-4 adjustments in ADP. If you don't want it through your W-2, you can also cut the IRS a check every quarter for the difference too. But like I said, that IRS tool is usually about the easiest, and then it'll give you a form and that'll help you answer the questions in ADP. And so this is what that form W-4 looks like. It's gotten a lot more complicated. If you remember about 3 or 4 years ago, you used to just mark single, married, filing jointly, how many do you want to claim dependents, and that was it. That's why I like that IRS tool. It kind of helps you figure out what you need to all fill out on this form. And if you end up using the IRS tool and not sure how to fill it out in ADP, I'm definitely, willing to help, or anyone in payroll as well. So, okay, Thank you all for listening. I really appreciate it. Benefits out there has that really good benefits, helpful link guide on, different links to your, Optum Financial, your retirement, John Hancock, where there's phone numbers, emails. Those are really great resources. Here's my email. If you guys have any follow-up questions, you get to your desk or you get together and you go over your finances and you have any questions about investing in your HSA or anything, I'm definitely happy to be a resource. With that, I think let's go ahead and open up for any additional questions or topics you guys want to talk about.
We've had a couple of questions in the chat. So somebody asked, and you might have to go back a few slides here. What do you mean by the tax deduction and the FSA dependent care?
Yes. So you can deduct anything that you put into your dependent care FSA is a tax-free contribution. And that those funds you use to pay for daycare. But if you are a, average middle class worker on your tax return, you get a dependent care income tax credit per child. But if you have used funds through your dependent care FSA, that will reduce the income tax credit that you get on your tax return.
All right. Along with that same question, somebody said the dependent care FSA isn't getting that credit up front and it can hurt the total amount received. So I think that's what you just explained.
Yes. Yep.
Okay. If that did not answer your question in the chat, please let me know. Then somebody asked, they said they may have missed it. How do we sign up for the Trump savings account?
So the only things you need is your child to have a social security card, and then it's just a simple form election that you file with your tax return, and they'll automatically set up an account and deposit the money in there for you. And this is all new and it's a work in process. And I saw the Trump savings account website still in progress. So it might change in the next couple months, but that's how they've explained the process so far.
All right, I think that's all we have. Nope, changed my mind. Can you go over the change in charitable contributions again?
Yeah. So this is for 2026. So this will be any charitable deductions that you do from the beginning of this year going forward. If you just take the standard deduction normally on your tax return, you can go ahead and automatically still deduct, if you're married, an additional $2,000 in cash contributions, in addition to your standard deduction. But if you itemize on your tax return, those charitable contributions, both cash and then, non-cash contributions like you donating clothes to Goodwill, those will get limited by 0.5% of your income. And so how I like to think of that is, whatever your income is, take 0.5% of that. And that's kind of what the government is telling you. That's what a normal person should contribute for charitable deductions. So it just gets limited. So if you want to get the full benefit, it's almost easier if you don't itemize sometimes, and if you just do a couple $100 here or there.
All right, next question for you, Rachel. Can you clarify that any catch-up contributions for 2026 must be after-tax or Roth contributions?
Yes, they are. Yeah. Yep. With John Hancock. So it's not required universally yet until 2027. So if your spouse has a retirement plan elsewhere, they might have to check with their plan. But I talked with Joy on Friday when I presented, and she said John Hancock made this change for 2026. So
Okay, so Joy Barksdale just chimed in and said that that is only if you made over 140,000 in 2025. So thanks for
Yes.
clarifying that,
Yep.
Joy. I am not seeing any other questions coming through the chat. So what do you think about leaving it open for another minute or so, Rachel? Does that sound okay?
Yeah. Yep, that works. I'll put my email up here too. Feel free to send me an email. Finances are kind of personal sometimes. So if you have it, something super personal or that you don't want to bring up on the screen, feel free to go ahead and email me this week and I'll be happy to respond as well.
Sounds great. There is one more question that just came through. Somebody said, so if my wife doesn't have a 401k, can I sign up to donate 401k for my wife?
When you say donate, whoever asked that, do you mean to a charity?
He said not donate, like create an account for his wife in John Hancock.
I'm not 100% sure on that. I don't think so because each person's 401k is based on their limit, like an individual limit, not a family limit. But you can definitely call John Hancock and see if they have any suggestions on your grand plan of things, but I'm kind of leaning towards no on that one.
Joy is also agreeing with that. She thinks no. So I think we're good on that. There are no other questions. Just want to thank you, Rachel, for presenting on this topic. This is a difficult thing to do, and I truly appreciate it. And I know you presented on Friday as well. So thanks for taking time out of your day. Thank you to everyone who joined. If this is part of the Financial Wellness Challenge for you, make sure you check this off on your reflection sheet. And otherwise, we hope to see all of you on Friday for our next Financial Wellness Seminar.